Once you retire and the paychecks stop coming, you'll rely on your first pension. But for most of you, there'll be an income gap, meaning your first pension will not cover 100% of your expenses in retirement. So you'll need to pull from an account to make up that income gap. But which account should you pull from first? Your traditional TSP, your Roth TSP, maybe a non-retirement brokerage account? Depending on which account you draw from first, the tax implications can be vastly different. And some of the methods can have terrible tax consequences. So in this video, we're going to cover the optimal order to withdraw retirement funds. To do that, we're going to cover understanding your fixed income sources. We're going to discuss understanding the tax implications of various account types. We'll also cover filling tax brackets strategically. And lastly, we'll discuss preparing for the big tax issue that most federal employees will face. Now, before we dive in, I'm Jose Armenta, and this is your Federal Employee Benefits, where we cover topics aimed at helping first federal employees like you make smart financial decisions. Now, if you're new here, hit that subscribe button so you don't miss any future videos. And if you're already a subscriber, welcome back. Okay, let's dive in. Okay, so the first step in determining the optimal order to withdraw your retirement funds is to calculate your fixed income. So for most of you, that's going to be your first pension, Social Security if you're eligible to file, and then some of you have rental income. That's going to be your fixed income sources. That's going to provide that floor. Now, the next step, once you have your fixed income sources, is you want to calculate the income gap. And again, that's the difference between your income sources and the amount of income you need in retirement. So for example, let's say John and Jane, they want retirement income of $10,000 a month, so $120,000 a year. Their first pension is $30,000. They're eligible for Social Security, and that's another $30,000 of benefits. So their fixed income sources are $60,000, but they want $100,000, meaning they have a $60,000 income gap. $60,000 is going to have to come from somewhere, right? It's going to have to come from one of their other assets, whether that's their traditional TSP, traditional Roth, or an IRA. Okay, the next thing you're going to want to do is understand the different account types that you have and the different tax statuses of each account. So let's go through the various accounts. The first account we'll cover is the traditional TSP or traditional IRA, right? Those accounts, you received a tax deduction when the money went in, but every dollar and the amount that went in was invested and grew tax deferred, but every dollar that is withdrawn from these accounts, your traditional TSP, traditional IRA, is taxable. Okay, every dollar you take out of these accounts will be taxed at your ordinary income tax rates, and you'll see them here. This is the top left table where the tax rates range from 10% to 37%. Now, most of you probably know this. We have a progressive tax system, so the more ordinary income tax or ordinary income that you have, the more of your money will be pushed into the next tax bracket. So the first $23,200 that you make, if you're married filing jointly, will be taxed at 10%. Over that amount, up to $94,300 will be taxed at 12%, and so on and so forth. And you move up those brackets, okay? If you're single, it's the same thing. It's just a smaller amount. So you can make up to $11,600 and be taxed at 10%. Any amount up over that, up to $47,150, is taxed at 12%, and so on and so forth. So that's how traditional TSP and traditional IRA are going to be taxed. They're going to be taxed at your ordinary income tax rates. Now, if you have a Roth TSP, Roth IRA, the benefit of those accounts is although you pay taxes up front, you didn't receive a tax deduction when you put the money into the account. It grew tax deferred inside the account, right? You paid no taxes on any dividends or interest or anything that was made in the account. And when you withdraw it, as long as it's a qualified distribution, okay, which is a fancy way of saying you met all the IRS rules for that withdrawal, then the withdrawal is tax-free, right? Those distributions are tax-free. Now, for most of you, the main rule is, are you 59 and a half? If you meet that rule, then most of the time it's going to be considered a qualified distribution. So that's the benefit of the Roth account, tax-free withdrawals. Now, lastly, we'll look at your taxable account, your non-retirement brokerage accounts. If you have an account at Vanguard, Fidelity, Charles Schwab, right? You can put as much money into those accounts. That's what's great about them. You can put as much money in them. There are no contribution limits like there are for retirement accounts, but any assets bought and sold at a gain, you will see it in the year that it's bought and sold. Okay, so there are tax implications in the year that you buy and sell assets, or there can be tax implications. Now, long-term capital gains, meaning that you held the investment in that account for longer than a year, those, when you sell those, you are going to be taxed at preferential rates, which are called the long-term capital gain rates. You'll see the table down here. So if you're married filing jointly and your income is under $94,050, any capital gains will be taxed at the 0% rate, meaning you're not going to pay any tax, which is great. And that's a very beneficial tax table to use, tax bracket system to use when you're in retirement. Now, if your income is between $94,051 and all the way up to $583,750, then your tax rate is 15%. Now, one thing to mention here is that if your investment was held for less than a year in this taxable account and sold at a gain, then the tax rate applied to that gain will be your ordinary income tax rates. Okay, you only get this preferential treatment if the investment was held for longer than a year. Okay, so something to keep in mind. But understanding the different tax statuses here and how they apply to your various accounts is critical to having an efficient withdrawal strategy. Okay, what we have here are my clients, John and Jane Doe, and they want to figure out what's the optimal withdrawal strategy. So we're going to look at a few examples of what might be the optimal withdrawal strategy and the impact of using one strategy versus another. Okay, so to start off, we're going to look at their investable assets, the retirement assets here. So they have a total net worth of $2,250,000, made up of $1.4 million in retirement investable assets. So traditional TSP with a balance of $650,000. We have a Roth TSP with a balance of $300,000. Then we have a non-retirement account with a balance of $500,000. This total amount of investable assets is about average for a couple retiring. Now, if we look at the cost basis, that's this amount here, $250,000. What that means is that's their principal plus any amount that they have paid taxes on over the years, such as dividends. So remember, when you are withdrawing from a non-retirement account, a taxable account, you're only going to pay taxes at the long-term capital gains rate, assuming it's a long-term capital gain, on the amount that is considered gain. So you're not paying it on the total amount, you're paying it on the difference between your principal or your cost basis, also known as cost basis, and the gain. So it's important to know here, and it's important when you're doing some tax planning. Okay, so their ratio of tax to withdrawals of 50% here for their taxable account. Now, if we move over to tax and click on the distribution tab. Okay, and by the way, this is the financial planning software that I use with my clients. And we're going to spend most of our time here on the distribution tab. And what we're looking at here is the various scenarios for different withdrawal strategies. And we can compare the overall impact on the retirement assets, on the portfolio that various withdrawal strategies will have. So now most folks will use the pro rata strategy where they're pulling out of each of their accounts equally. But let's compare what the impact is if we switch that strategy, okay? And by the way, these lines here are the different brackets, the ordinary income tax brackets, and then that dark blue in the back, that is their taxable income. And you can see how their taxable income changes throughout the years. And this big spike here, that's their RMD age at 75. So that's one reason why tax planning is so important, is because you do have that line in the sand in retirement that you want to plan for, okay, where the IRS will come and require that you make minimum distributions from your traditional retirement accounts, so that traditional TSP, IRAs, 401ks, things like that. Now let's go in here and let's compare let's say if they were to go ahead and do a withdrawal from taxable, so the non-retirement account first, then move on to their traditional account, so tax deferred account, and then lastly use that Roth account last, okay, the Roth TSP last. And how does that impact their adjusted portfolio balance? And we can see here that moving from the pro rata, the proposed strategy here, moving from the pro rata to using the taxable account, the tax deferred, and then the Roth, the tax-free account last, will increase their adjusted portfolio balance by $873,000. That's a huge amount right there, a huge amount a huge increase in their investable assets throughout their retirement. So at the end of retirement, they're going to have $873,000 more, according to this projection, just by switching that withdrawal strategy. Now let's look at one more withdrawal strategy and see how that might change things. So we did the non-retirement account first, then moved on to the traditional and then tax-free last. What happens if we do tax-deferred first? Wow. So 2 million less. So this is actually worse than the pro rata. If they were to use the tax-deferred first, so the traditional account, then the non-retirement account, and then tax-free last, they would end up with 2 million less at the end of retirement in the retirement accounts than had they did pro rata or the second strategy, which was the tax-free, tax-deferred, and then Roth last. Okay, so you see the impact that having the right withdrawal strategy can have on your retirement assets. So it's critically important to review that. Now, this is going to be different for everyone. Some folks, it's going to make sense to have a different amount of withdrawal for each account at the same time. So for instance, it may make sense for a lot of folks to take some out of your traditional account and just enough to fill up your deduction, your standard deduction for the year, then moving on to your taxable account. Okay, so you can get some of that 0% capital gains rate, and then move on to the tax-free. Okay, just depends on the various accounts that you have available and the balances of each account. Okay, so every situation is going to be different, but this gives you a good example of the impact that the optimal strategy can have on your retirement assets. I hope you enjoyed the video. If you did, please hit that like and subscribe button. That's the best way to support this channel. And if you're interested in learning more about how my financial planning firm can help you with your financial planning and retirement needs, go ahead and use the link below to schedule a free consultation today.